What if the most responsible financial advice you follow is the exact reason you aren't wealthy yet? We're taught debt is the enemy. That being debt-free is the ultimate win. But mathematically, that sense of safety can cost you hundreds of thousands of dollars in missed opportunities. Today I'll show you the math banks and wealthy investors use. Numbers most savers never run. No hype, no shortcuts. Just clear thinking, simple math, and a different way of looking at the same rule you've heard your whole life. Let's be honest for a moment. The rule didn't come out of nowhere. Avoiding debt does protect people, especially from the worst kinds of financial mistakes. High-interest credit cards, personal loans for things that lose value, buying lifestyle upgrades before income can support them. That kind of debt is poison. It drains cash flow. It keeps people stressed, stuck, and reactive. So when someone says, debt is bad, they're not lying. They're just stopping the explanation too early. Because the real mistake isn't debt itself. The mistake is treating all debt as the same thing. That single oversimplification is where most people lose decades. Here's the distinction that changes everything. Some debt finances consumption. Other debt finances assets. Consumption debt buys things that shrink in value or disappear entirely. Assets, on the other hand, can grow or produce income. Now let's make this real. Think about how most people search for how to make a website. They scroll past the results and move on. A wealthy investor sees something else. They see a potential asset. Imagine borrowing $300 to pay for hosting, a domain, and a professional theme. Technically, you're in debt. You owe money. But if that website becomes a service page or a small digital store that brings in $100 a month, the math changes. That $300 didn't buy a toy. It bought a system. It bought something that can work for you, day and night, paying itself back. That's how the wealthy think. They don't ask, is debt good or bad? They ask, what does this debt buy me? If the answer is stress, payments, and regret, they avoid it. If the answer is control over an income-producing asset, like that website, they run the numbers. That's the mindset shift. Debt stops being emotional. It becomes mechanical. Here's the thing most people never stop to consider. The biggest obstacle isn't the debt itself. It's the way we think about money. Most of us have been trained to value safety over opportunity, to avoid risk at all costs, to feel guilty for spending, anxious about borrowing, and cautious to the point of stagnation. That mindset protects against disasters, but it also keeps people stuck in the slow lane. They watch opportunities pass by. They save every dollar they can, yet rarely ask the one crucial question: could this money actually work harder than I can? The wealthy think differently. They treat money as a tool, not a burden. They ask questions like, what will this payment get me in return? Does this asset increase my freedom or just my stress? Can I afford the risk without jeopardizing my life? Shifting from fear to curiosity, from instinctive caution to calculated strategy, is often the single biggest difference between staying stuck and accelerating toward real wealth. And once you see money this way, the next step becomes obvious. You start looking at every decision mathematically, not emotionally. And that's exactly what allows small choices to compound into massive outcomes over time. Let's slow down and look at a clean example. Imagine two people with the same income, the same discipline, and the same mortgage interest rate. One person throws every extra dollar at paying off the loan early. It feels productive. It feels safe. The other person does something that feels uncomfortable. They make the regular payments and invest the extra money instead. If the mortgage costs 4% per year and the investments earn 7 or 8% over the long run, the second person quietly pulls ahead. Not overnight, not dramatically, but over years. then decades. Compounding turns that small gap into a massive difference. By retirement, the person who felt safer can easily end up hundreds of thousands behind the person who let their money work harder earlier. The rule that promised safety created opportunity cost. And opportunity cost is invisible until it's too late. At one point, I deliberately went about $12,000 into manageable strategic debt. Everything I'd been taught told me it was a mistake. But that money didn't go toward lifestyle. It went toward an asset that paid for itself. That one decision taught me something powerful. Money can either sit still, or it can be leveraged to move faster. The debt wasn't the risk. Ignoring the math would have been. Here's the cleanest way to think about it. Bad debt makes your future smaller. Good debt has the potential to make it bigger. Bad debt demands payments without giving anything back. Good debt at least has a chance to cover itself, or even pay you. That's why mortgages, business loans, and investment leverage show up again and again in wealthy balance sheets. Not because they love debt, but because they understand leverage. If this is already changing how you think about money, do me a favor. Pause the video for a second, look at your own situation, and ask one simple question. What is my money actually doing right now? If you want more videos that break down money like this, calmly, clearly, without hype, subscribe. That's exactly what this channel is for. All right, let's keep going. The wealthy don't chase debt. They use it with rules. They borrow at low rates. They invest in things that produce cash flow or long-term growth. They leave enough margin, so one bad year doesn't wipe them out. They're patient. And most importantly, they never confuse leverage with gambling. Debt magnifies outcomes. That's why discipline matters more than intelligence. This approach isn't for everyone. If someone is drowning in high-interest debt, the priority is survival, not optimization. If income is unstable, leverage adds stress instead of opportunity. Strategic debt works best when there's time, stability, and margin, years to compound, income to absorb volatility, and a safety net for when life does what it always does, surprise you. So what's the real rule? Not avoid debt at all costs. The better rule is this: be ruthless with bad debt. Be curious, disciplined, and mathematical about good debt. Kill anything with toxic interest rates. Respect leverage. Never rush. Never assume best-case outcomes. Let time do the work. That's how wealth is actually built. Quietly, slowly, and deliberately. If you want to go deeper and keep learning, check out the suggestions on your screen for more videos that break down money clearly, calmly, and without hype. And if there's one money rule you were taught that never quite made sense, drop it in the comments. That's exactly where the ideas for the best future videos come from. Thanks for watching. See you in the next one.